These 8 states are quietly taking as much as $3,000 a year from retirees, and most seniors do not even realize they are affected. The roster of states shrank in 2026. West Virginia finally stopped taxing Social Security benefits on January 1st. That change leaves 8 remaining states that still skim money from your benefit check before it even reaches you. But here is the part almost nobody explains. Even in the states that just repealed their tax, some retirees are actually paying more this year than they did last year. Not less, more. That is because a separate rule baked into the federal tax code layers on top of every state rule. And in the wrong state, the combined effect can silently strip between $1,000 and $3,000 a year from a retiree's budget without ever appearing as a separate charge. Most retirees never see this because the state does not label it a Social Security tax. It is tucked into the ordinary income tax form as a taxable share of your benefits. You only spot it when you run the numbers. And when you do, it is usually too late to reverse the decision that pushed you over the line. By the end of this video, you will know the exact 8 states still on the list for 2026. How each state decides whether your benefits are taxable, the 2 separate federal income thresholds that sit on top of every state rule, the 1 new deduction Congress quietly introduced in 2025 that partially offsets the hit for anyone over 65, and the 5 strategies that can cut or eliminate this exposure before the current tax year ends. Mark here, with more than 10 years inside the financial world watching retirees get blindsided by rules no one ever walked them through. Today's rule is one of the worst because it is practically invisible. Most retirees living in these 8 states do not find out their state taxes Social Security until the first year they unexpectedly owe. Therefore, the first crucial step is simply knowing whether you are in one of those states. There are actually 2 completely different methods a state can use to reach into your benefit check. The first group is the easiest to understand. 4 of the 8 states apply a flat percentage to the portion of your Social Security that is already taxable at the federal level, no matter how high or how low your total income might be. Those 4 states are Colorado, Utah, Montana, and Minnesota. If you live in one of these 4 and any fraction of your Social Security appears as taxable on your federal return, the state automatically takes a slice. Colorado is the most common trap because the state markets itself as friendly to retirees. Colorado imposes a flat 4.4% income tax. Retirees age 65 and older are allowed to deduct the full federally taxable share of their Social Security. That sounds straightforward, but here is the hidden catch. Retirees between age 55 and 64 can only deduct up to $75,000 of retirement income if single, or $95,000 if married filing jointly. Therefore, any early retiree who begins Social Security before 65, which is typical for someone who claims at 62 to cover a gap year, gets hit with the full 4.4% on the taxable portion until the calendar year they reach 65. For a couple receiving $30,000 a year in benefits with 85% of that amount taxable at the federal level. The Colorado cost before 65 tops $1,000 a year, and most of them do not find out until the tax return is prepared. Look at the pattern of a Colorado couple in their early 60s. One spouse retired at 62 and started Social Security as soon as possible. The other spouse is still working part-time to keep health insurance going until Medicare starts. Together, their income ends up just above the $75,000 single filer retirement deduction limit because the working spouse's earnings by themselves cross that threshold. Therefore, Colorado's full 4.4% rate falls on the taxable portion of the early claimant's Social Security. Over the 3-year stretch between early claiming and age 65, the household pays over $3,000 in state tax on benefits that would have been completely exempt if they had timed things differently. That money is gone forever. Nothing is refunded when they turn 65. It is simply the cost of drawing Social Security in Colorado before the age-based deduction becomes available. Utah is the next one. Utah charges a flat 4.5% income tax. The state offers a credit for Social Security benefits, but that credit phases out as income climbs. Full exemption applies only when adjusted gross income is below $54,000 for a single filer or $90,000 for a married couple filing jointly. Therefore, the Utah retiree whose combined income from a pension, part-time work, and required minimum distributions nudges them past the threshold, loses the credit entirely. For a couple just above the $90,000 mark, the added state tax on benefits that the federal government is already taxing up to 85% of can reach $1,400 a year. Montana taxes Social Security using the same formula the federal government uses, which sounds easy until you learn that Montana uses income thresholds that have not moved in years. The base figure is only $32,000 for a married couple filing jointly, or $25,000 for someone filing single. Those cutoff points were set decades ago and never indexed for inflation. Therefore, almost every Montana retiree with any extra income at all has up to 50% of their benefits pulled into the state tax base, and Montana's rate on that slice can run as high as 5.65%. For a couple receiving $28,000 of benefits with half of that included, the Montana charge is close to $800 a year. Not devastating by itself, but it stacks on top of everything else. Minnesota is the fourth flat state and also the most complicated. Minnesota offers a subtraction that fully shelters Social Security for couples with adjusted gross income under $18,120 or single filers under $84,490. Below those figures, you owe nothing. Above those figures, the subtraction starts to phase out and the state tax ramps up quickly. Roughly 29% of Minnesota beneficiaries still pay state tax on their benefits. That is almost 1 in 3 retirees in the state. And for those caught in the phase-out band, the average hit runs between $1,200 and $2,200 a year. Therefore, if you live in Colorado, Utah, Montana, or Minnesota, and your income is anywhere above the exemption levels I just described, the state is collecting from your Social Security every year. Most retirees in these 4 states never see a separate notice. The charge is blended into the standard state income tax form, but the other 4 states use a completely different method. The second group of 4 states is where timing traps appear. Connecticut, New Mexico, Rhode Island, and Vermont do not use a simple flat rate. They rely on adjusted gross income thresholds. If your income stays below a particular figure, none of your benefits are taxed. If your income exceeds that figure by just $1, the taxable portion kicks in and the state begins collecting. The trap is that many retirees cross these lines not because of ongoing income, but because of a one-time event, a Roth conversion, an unusually large required minimum distribution, the sale of a rental property or vacation home. Any single large taxable event in one calendar year can push a retiree above the threshold and trigger state tax on benefits that were fully exempt the prior year. Connecticut begins taxing at $75,000 of federal adjusted gross income for a single filer or $100,000 for a married couple filing jointly. Above that level, Connecticut taxes up to 25% of Social Security benefits at the state rate. That sounds like a hard ceiling, but the cap applies to the percentage, not the dollars. Therefore, a couple with $120,000 of adjusted gross income and $36,000 in Social Security payments will see up to $9,000 of those benefits pulled into state taxable income, and Connecticut's tax on that slice can approach $600. Consider the pattern of a Connecticut retiree at age 70. For 6 straight years, she paid no state tax on Social Security because her ordinary income sat just under the $90,000 level. In 1 year, she chose to convert $60,000 from her traditional IRA into a Roth account on the suggestion of a friend instead of a tax expert. That conversion added $60,000 to her adjusted gross income for that 1 year and shoved her above the $100,000 threshold. The state instantly exposed 25% of her benefits to Connecticut income tax. The extra state tax alone came to almost $500 that year. But the bigger issue was that the same conversion pushed her federal combined income far past the 85% mark, adding several $1,000s to her federal bill. If she had spread the conversion into 3 smaller annual moves, each staying under the state line, the tax impact would have been nearly zero. One brief conversation with a certified public accountant before the conversion would have changed everything. But once she filed her return, the year was over and the move could not be reversed. New Mexico sets higher thresholds, which makes them easier to stay under. Single filers earning less than $100,000 or couples earning less than $150,000 can fully deduct their Social Security payments. But the moment income rises even slightly above those marks, the deduction vanishes entirely. There is no gradual phase out in New Mexico for most taxpayers. That creates what many advisors call a cliff. Being $1 over the threshold can cost hundreds in state tax because the deduction does not shrink gradually. It simply shuts off. For a New Mexico retiree hovering near the line, a single Roth conversion completed without checking total income for the year can trigger a state tax bill on benefits that were exempt the year before and will be exempt again the year after. Rhode Island is the third state in this cluster, and it uses a different type of measurement. The state only exempts Social Security for retirees who have reached full retirement age, which is 67 for most people now nearing retirement, and whose adjusted gross income is below $117,000 for most filing statuses, or $133,750 for a married couple filing jointly. Therefore, a retiree who files for Social Security early at 62 with the goal of drawing income before full retirement age is taxed by Rhode Island on the full federally taxable portion during those 5 years, regardless of overall income. The trap here is driven by age, not income, and most early claimants never realize the rule exists. Vermont is the final state in the second group. Vermont fully exempts Social Security for joint filers with adjusted gross income of $70,000 or less, or for single filers and those married filing separately at $55,000 or less. Between those amounts and a higher phase-out limit, a partial exemption applies. Above the upper line, the full federally taxable share is taxed at Vermont's normal rate, which ranges between 3.34% and 8.34% depending on total income. For a Vermont retiree who picks up a partial year of extra income from consulting work or a one-time distribution, the state tax on Social Security can jump from $0 to nearly $1,500 in a single year. Therefore, the second group of 4 states, Connecticut, New Mexico, Rhode Island, and Vermont, creates a timing issue that does not exist in the first group. You can remain under the line for a decade and then trigger the tax in one unlucky year because of a single decision you never realized was tied to Social Security at all. But here's the twist that surprises almost every retiree. Even if you live in one of the 42 states that does not tax Social Security, the federal government is still taxing up to 85% of your benefit. This rule appears in Internal Revenue Code Section 86 and has been in place since 1983. The core problem is that the income thresholds that trigger federal tax on Social Security have never been updated for inflation, not once in more than 40 years. Those federal thresholds are $25,000 of combined income for a single filer or $32,000 of combined income for a married couple filing jointly. Combined income is defined as adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. Above the first threshold, up to 50% of benefits become taxable at the federal level. Above a second threshold, $34,000 for single filers or $44,000 for joint filers. Up to 85% of benefits become taxable. These figures were set 4 decades ago. $1 then is roughly equal to $3 today. Therefore, nearly every retiree with any meaningful outside income now finds themselves in the 85% federal tax zone. The combined effect of state tax on Social Security plus federal tax on Social Security is where the real cost appears. A couple in Vermont drawing $36,000 in benefits with combined income of $80,000 can see $30,600 of those benefits taxed federally, plus an added state charge on the share Vermont includes. The federal tax on that slice alone at the 22% bracket is over $6,700. Vermont's tax on top adds another $1,000 to $1,500. Therefore, the combined tax on Social Security benefits alone can top $8,000 a year, and most of that comes from the federal rule, not the state rule. Most retirees never separate the two in their mind, and as a result, they never explore the strategies that reduce the stack. Look at the situation of a Minnesota couple in their mid-70s. They live in a home that is fully paid off. They receive a modest pension of $24,000 a year and both receive Social Security. Their combined Social Security totals $34,000 a year. Their required minimum distributions from a traditional IRA add another $45,000. Their adjusted gross income lands at roughly $103,000. They feel secure. They have never thought of themselves as high income, but their combined income under the federal Social Security formula comes in far above the $44,000 second threshold, which means 85% of their benefits are taxable at the federal level. On top of that, their $103,000 adjusted gross income sits just under the Minnesota subtraction level of $118,320, which means the state subtraction still protects them this year. One larger distribution next year, triggered by a market gain that boosts the account balance used to calculate the required minimum, would push them over the limit. The state tax on their benefits would rise from $0 to about $1,800 in 1 year, and neither they nor their tax preparer would necessarily link the change to Social Security. They would simply notice a larger state bill and not understand the cause. But Congress did quietly create one offset in 2025 that almost no retiree knows about. It is called the senior deduction, and it was enacted as part of the One Big Beautiful Bill Act. This rule allows an extra $6,000 deduction for taxpayers age 65 and older on top of the regular standard deduction for the tax years 2025 through 2028. For a married couple where both spouses are 65 or older, the combined extra deduction is $12,000. The senior deduction phases out as income increases. Full use is available for single filers with modified adjusted gross income at or below $75,000 or for couples at or below $150,000. Above those amounts, the deduction begins to phase out and disappears entirely at higher incomes. Therefore, middle-income retirees, the group most likely to fall into the 85% federal tax zone, get the most benefit from the new deduction. The Treasury Department has estimated that because of this deduction, roughly 88% of Social Security recipients now pay no federal tax on their benefits. But that headline number hides the truth for the remaining 12%. The 12% who do pay are usually retirees with larger pensions, larger portfolios, and larger required minimum distributions. And for this group, the senior deduction only softens part of the blow. It does not remove it. Just as important, the senior deduction is federal only. It has no impact on the state rules in any of the 8 states we covered. Therefore, the full picture for a retiree in one of the 8 taxing states looks like this. The federal government taxes up to 85% of benefits for anyone above thresholds that have not moved since the Reagan era. The state adds its own layer on top, and the new $6,000 senior deduction offsets part of the federal cost, but none of the state cost. A retiree who does not review these numbers each year is almost certainly paying somewhere between $1,000 and $3,000 more than necessary. The upside is that there are 5 specific strategies that can cut or completely remove this exposure, and every one of them is legal, clearly spelled out in the tax code, and widely used by retirees who work with a tax professional. The first strategy is the threshold gap year. If you know you will have a low-income year, for example, the year after you stop working and before you turn on Social Security, that is the ideal time to complete any large Roth conversion, harvest capital gains, or take extra withdrawals from retirement accounts. Your income remains under both the state and federal thresholds, the tax impact is small, and the money moves into accounts that will never trigger the Social Security tax rules again. A certified public accountant or enrolled agent can calculate the exact breakpoints for your state and your income before December. The second strategy is doisal review. Moving to a state that does not tax Social Security is not a quick or casual fix. It demands a true doisal change, not just purchasing a vacation property. A tax attorney or state tax specialist should handle the formal steps if you decide to relocate. For a retiree already thinking about moving to be closer to family or for lifestyle reasons, checking whether your target state is one of the 42 that does not tax Social Security is essential. Arizona, Florida, Nevada, Pennsylvania, South Dakota, Tennessee, Texas, Washington, and Wyoming impose no state income tax on retirement income at all. Each state has its own criteria for what counts as domicile. The key point is that every state audits domicile using similar evidence: your driver's license, your voter registration, where your primary doctor's office is located, where your mail is delivered, and how many nights you physically spend in the new state all matter. Most states apply a 183-day rule, meaning if you spend more than half the year in your old state still treats you as a resident for tax purposes. Therefore, the retiree who moves to Florida in January but spends the entire summer back at the lake house in Minnesota can easily end up owing state tax in both states for that transition year. A tax attorney should walk through the specific DOISL standards before you move, not afterward. The third strategy is timing Roth conversions. For retirees living in Connecticut, New Mexico, Rhode Island, or Vermont, doing a Roth conversion in a year when your income is already close to the state threshold is a costly mistake. Completing the same conversion in a year when your income is clearly well below or clearly well above the line is cheaper because it either avoids the cliff entirely or triggers the cliff once instead of spreading it over several years. A certified financial planner or tax professional should model the multi-year effect before you complete any conversion above $50,000. The fourth strategy is using qualified charitable distributions. A qualified charitable distribution allows a retiree over age 70 and a half to send up to $18,000 per year in 2026 directly from an IRA to an eligible charity. That payment does not count as taxable income. It covers the required minimum distribution, but keeps adjusted gross income lower. Therefore, the qualified charitable distribution can be the single most powerful tool for a retiree hovering near a state threshold who was already planning to donate to charity. A tax preparer or enrolled agent must set up the transfer correctly. If the money passes through your hands first, the exclusion disappears. The fifth strategy is managing the timing of the required minimum distribution itself. Federal rules require your first required minimum distribution by April 1st of the year after you turn 73. Taking that first distribution in the year you actually turn 73 instead of delaying until the following April 1st spreads the withdrawals over 2 calendar years instead of stacking 2 into 1. For a retiree near a state Social Security threshold, that stacking can push combined income from below the line to above the line for a single year, triggering state tax on benefits. Splitting the payout keeps each year's adjusted gross income cleaner. A tax professional should decide based on estimated income in both years. These 5 strategies are all legal, all written into the tax code, and all commonly used by retirees who sit down with a certified public accountant, an enrolled agent, or a tax attorney annually. The common thread is that they must be executed before December 31st, not afterward. Once the calendar year ends, most of these moves are off the table. The 8 states still taxing Social Security in 2026 are Colorado, Utah, Montana, Minnesota, Connecticut, New Mexico, Rhode Island, and Vermont. West Virginia has just exited the list. The federal government taxes up to 85% of benefits for every retiree above thresholds that have not been adjusted since 1983. The new senior deduction reduces part of the federal cost for many retirees, but none of the state cost. And the combined yearly price of ignoring these rules for a retiree in the wrong state with the wrong timing on a Roth conversion or property sale is between $1,000 and $3,000 every single year, year after year, for as long as you are retired. Your first step this week is to pull your latest state tax return and find the line showing the taxable portion of Social Security benefits. If that line is greater than 0 and you live in one of the 8 states, you are on the list. The second step is to contact a certified public accountant or enrolled agent before year end and ask for a projection of your combined income relative to both the state and federal thresholds for this tax year. The third step is to decide, based on that projection, whether any of the 5 strategies fits your situation. Take action before December 31st.